Something just flipped in the gold and silver market, not a small shift, a real change in direction. Just weeks ago, the entire story was about falling rates and cooling tension. Now the tone has changed almost overnight. If you own gold, if you own silver, or if you're deciding whether tomorrow is the day to buy, you need to hear this before you make your next move. Stay with me because the next 20 minutes could completely reshape how you think about these markets. Welcome back to Silver and Gold Watch. Every day we break down exactly what's driving these markets in simple, honest language. And today, there's a genuine shift happening that deserves your full attention. Let's get into it. For weeks, the narrative around gold and silver was fairly straightforward. Inflation fears were easing, rate hike expectations were fading, oil prices were falling. Everything pointed toward a friendlier environment for precious metals. But something just changed, and it changed fast. Tensions in the Strait of Hormuz have flared back up. For those unfamiliar, that narrow stretch of water is one of the most important oil transport routes on the entire planet. A massive share of the world's daily oil supply moves through it. When tension rises, their oil prices react almost immediately, and that's exactly what just happened. Oil prices pushed higher again this week as reports emerged that Iran is seeking to restrict certain vessels from passing through the strait while demanding compensation from nations it considers hostile before granting safe passage. That's a serious escalation, and markets are taking it seriously. Here's why this matters so much for gold and silver. Rising oil prices tend to reignite inflation concerns almost instantly. Energy costs feed into nearly everything: transportation, manufacturing, shipping, even the price of goods sitting on store shelves. When oil climbs quickly, those inflation fears come rushing back into the conversation. And that changes the entire calculation for the Federal Reserve. Just recently, markets were pricing in fewer rate hikes for the rest of the year. Now that expectation is shifting the other direction. Federal Reserve officials have increasingly signaled they may be prepared to raise interest rates again soon if inflation pressures keep building. Markets are now pricing in the real possibility of another rate hike as early as next month. That's a meaningful reversal from where sentiment stood just a short time ago. This is exactly the kind of shift that creates real volatility in precious metals. Gold and silver don't pay interest. They don't pay dividends. So when interest rates rise, or even when the market simply expects them to rise, these metals become less attractive compared to other assets that do generate steady returns. That's part of why we've seen some pressure show up in silver recently. Silver slipped toward the $61 range this week after touching stronger levels just days earlier. That's a meaningful pullback in a short window of time. But here's where the story gets more complicated. And this is the part most headlines are missing entirely. While the short-term picture looks shaky, the deeper structural story underneath silver hasn't gone anywhere. Industrial demand for silver remains incredibly strong. Recent trade data out of China showed silver-bearing ore imports surging more than 60% compared to the same period last year. That's an enormous jump, and it lines up directly with expanding solar panel production and continued build-out of electrical grid infrastructure across the region. Silver isn't just a monetary metal reacting to Fed policy, it's a critical industrial input that the clean energy transition depends on. That demand doesn't simply disappear because of a short-term shift in interest rate expectations. So what we're really watching right now is a tug-of-war. On one side you have rising rate hike expectations and renewed geopolitical tension pulling precious metals lower in the short term. On the other side, you have powerful structural demand for silver continuing to build underneath the surface, regardless of what happens with monetary policy this month or next. That tug-of-war is exactly why we're seeing choppy price action right now instead of a clean trend in either direction. Let's zoom out for a moment because context matters here. Both gold and silver had extraordinary runs over the past year. Gold pushed well past $4,000 an ounce and even touched levels near $5,600 at its peak earlier this year. Silver's run was even more dramatic, climbing from around $40 an ounce all the way toward $116 at its high. Since those peaks, both metals have pulled back significantly. Gold has given back a modest portion of its gains. Silver has pulled back more sharply, reflecting just how far and how fast it had climbed. This kind of cooling off period after a historic rally is completely normal. Markets rarely move in a straight line forever. Sharp advances are almost always followed by periods of consolidation or correction before the next major move develops. Now let's talk about what could determine where things go from here. The first thing to watch closely is what actually happens in the Strait of Hormuz over the coming days. If tensions continue escalating, oil prices could keep climbing, and that would likely keep inflation concerns elevated. That scenario tends to support gold even while pressuring assets tied more closely to industrial demand cycles. If tensions ease instead and diplomatic solutions emerge, the entire calculation could shift back the other direction almost as quickly as it changed this week. The second thing to watch is the Federal Reserve's next move. If inflation data continues coming in hot, expect officials to keep leaning toward additional rate hikes. If inflation data cools even slightly, that could take some pressure off and allow gold and silver room to stabilize or climb again. This is precisely why markets have been so sensitive to every single word coming out of Federal Reserve commentary lately. A single sentence from a single official can shift sentiment within minutes. The third thing to watch is central bank buying activity. Even during periods of short-term volatility, central banks around the world have continued steadily accumulating gold. This isn't emotional or reactive buying. It's long-term strategic positioning designed to hedge against currency risk and global instability, regardless of what happens with short-term interest rate decisions. That kind of steady demand tends to provide a floor underneath gold prices even when sentiment turns choppy in the short run. And the fourth thing to watch closely is the US dollar. Precious metals and the dollar typically move in opposite directions. When the dollar strengthens, gold and silver often face additional pressure because they become more expensive for buyers using other currencies. When the dollar weakens, the opposite tends to happen. Right now, the dollar has been reacting to the same shifting rate expectations we just discussed, which means dollar strength could become another headwind if the Fed leans more aggressively toward tightening in the months ahead. So let's bring all of this together into something practical you can actually use. If you already own gold or silver, understand that short-term pullbacks like we're seeing right now don't necessarily mean the broader story has changed. They often reflect shifting expectations around interest rates and geopolitical risk, rather than any change in the long-term fundamentals driving these markets. Central banks are still buying. Industrial demand for silver is still climbing. Currency uncertainty around the world hasn't disappeared. Those forces don't reverse overnight just because rate hike odds shifted for a few weeks. If you're considering buying for the first time, this kind of volatility can actually create opportunity for investors who understand the bigger picture instead of reacting purely to daily headlines. Pullbacks after historic rallies have happened many times throughout precious metals history. They're rarely comfortable in the moment, but they've often set the stage for the next leg higher once the underlying pressures resolve themselves one way or another. That said, I want to be completely balanced here because that matters more than anything else. If inflation keeps accelerating and the Federal Reserve responds aggressively, that could create real and sustained pressure on both metals in the near term. If geopolitical tension in the Middle East escalates further beyond what we're seeing right now, that introduces a level of unpredictability that even seasoned analysts find difficult to forecast with confidence. Nobody has a perfect crystal ball here. What matters is understanding the forces at play so you can make informed decisions instead of emotional ones. Here's something worth remembering as we wrap up. Precious metals have gone through cycles like this for generations. Sharp rallies followed by sharp pullbacks, followed by periods of consolidation before the next major move. The headlines driving each cycle change. Sometimes it's a banking crisis. Sometimes it's a currency intervention. Sometimes it's a flare-up in a critical shipping route halfway around the world. But the underlying pattern of uncertainty, driving demand for real tangible assets, tends to repeat itself again and again across decades. What makes this particular moment worth watching closely is the speed of the shift. Just weeks ago, the narrative was almost entirely about easing conditions and falling rate expectations. Now, within a matter of days, that narrative has flipped toward renewed inflation concern and rising rate hike odds. That kind of rapid reversal tends to create exactly the kind of choppy, unpredictable price action we're seeing right now. Understanding why it's happening puts you in a far stronger position than simply watching the ticker move without context. Going forward, keep a close eye on developments coming out of the Middle East because that single factor could shape sentiment across energy and metals markets simultaneously. Keep watching Federal Reserve commentary heading into the next policy meeting because officials have made clear they're prepared to act if inflation data continues surprising to the upside. Keep an eye on industrial demand data, particularly out of China, because that structural silver story remains one of the most important long-term threads running underneath this entire market. And keep watching the dollar, because its direction often tells you just as much about where gold and silver are headed as any single headline does. Markets rarely move in a perfectly straight line. What we're witnessing right now is a genuine shift in the underlying narrative, not a collapse, not a guaranteed continuation of the old trend either, just a real change in the forces currently pulling on these markets. Staying informed through moments like this is exactly what separates investors who make confident decisions from those who simply react to whatever headline crosses their screen that day. If this video helped you understand what actually changed and why it matters, make sure you hit that like button right now. It genuinely helps this channel reach more people who need clear information before making decisions with their own money. If you haven't subscribed yet, now is the perfect time, because we'll be tracking every twist in this story as it continues developing in real time. And I want to hear from you directly. Drop a comment below and tell me this. Do you think this shift is temporary, or do you think we're entering a genuinely new phase for gold and silver? I read every comment, and I'll be responding to as many as I can. Thank you for watching Silver and Gold Watch. Stay sharp, stay informed, and I'll see you in the next video.